starting to invest. Okay, something a lot of us feel we should be doing, right? Feels like this really important step. But let's be honest, when you're just starting out, that excitement, it can definitely mix with, well, a bit of anxiety. Or maybe a lot.
Oh, absolutely. That feeling of being overwhelmed is so common.
Yeah, where do you even begin? There's so much info floating around.
You nailed it. Cutting through all the noise, the jargon, figuring out what's solid advice versus, just hype. That's a real hurdle for newcomers.
And that's exactly what we're trying to do in this deep dive. We took a whole bunch of sources, articles, some research, even thoughts from listeners starting their journey.
Right.
And we've boiled them down. The mission, pull out the really crucial, actionable stuff you need now, and maybe help you sidestep some of those classic, sometimes painful beginner mistakes.
Think of it like a guide, basically. Building that solid foundation for your investing future. We're not talking super complex strategies here.
No, definitely not.
More like simple long-term approaches that the sources suggest really work when you're starting out.
Okay, let's dive right in then. We'll start by looking at what one source called, pretty vividly, the beginner's minefield.
Good name for it.
Because, look, everyone makes mistakes, but knowing where the common traps are, that's your best defense.
And the sources seem pretty much aligned on the number one danger lurking there. It's not always a market crash or picking a bad stock. It's closer to home.
Emotional decision-making.
Exactly. Emotional decision-making.
That knee-jerk reaction, right? Selling everything when the market dips.
Panic selling, yeah.
Or the opposite, getting caught up in the excitement, buying like crazy when things are soaring and everyone's talking about it.
One source we looked at, that Mintos article, was really blunt. It called buying high out of excitement and selling low out of fear. Basically, a guaranteed recipe for losing money.
Ouch. But it makes sense.
It does, because market swings.
Yeah.
They're totally normal. The sources really stress this. Reacting impulsively to those short-term moves, driven by fear or greed, that's the opposite of a solid plan.
So the antidote is sticking to your long-term plan.
Precisely. Which kind of leads into another big mistake. Chasing those super high returns.
The siren song of the hot stock.
Right. Or that trendy new thing everyone swears will double your money overnight.
It's tempting, no doubt.
For sure. But the sources warn, pretty consistently, that those flashy, high-reward promises, they almost always come packed with much higher risks. It's that classic trade-off.
And beginners sometimes, underestimate the risk part of that equation.
Definitely. And chasing those returns often goes hand in hand with mistake number 3, not doing your homework.
Yeah, the research part. One source literally said investing without proper research is like gambling. Just acting on a tip from a buddy or jumping on whatever's trending on social media without really understanding what you're buying.
Exactly. You got to understand, how does this thing work? What's its track record? What are the downsides? Being informed cuts down the gambling feel quite a bit.
Okay, and speaking of risk, another huge pitfall is the lack of diversification.
Oh yeah, putting all your money in one asset class, as the sources say.
Whether that's just one company's stock or maybe only real estate or, just one type of crypto.
And the danger is pretty obvious, right? If that one thing, that single company or asset class takes a nosedive.
Your whole investment is at risk.
Right. The sources are super clear. You need to spread your investments across multiple asset classes.
Things like stocks, bonds, maybe ETFs.
Yeah.
Later on, maybe you look at REITs or even peer-to-peer lending.
The idea isn't to get rid of risk completely. You can't really do that. It's about reducing the hit if one area tanks, creating, as one source put it, a more stable foundation.
Like a table with 4 legs instead of just one wobbly one in the middle.
Good analogy. Then there's overconfidence. You have a couple of early wins, the market's going up.
And suddenly you feel like a genius.
Yeah, exactly. But the sources universally warn against this. They say no one can time the market perfectly, not even the pros.
Trying to predict those short-term moves consistently, it's just incredibly tough, and it often leads to making bad calls at the wrong time.
Which flows right into ignoring risk management. And this isn't just about diversification again. It's about understanding your own tolerance for risk, your comfort level with uncertainty.
Before you invest anything.
Absolutely. Before $1. How okay are you personally with seeing your investment value drop sometimes?
Sure.
Can you handle volatility, or do you need things to be more steady?
Asking yourself that honestly is crucial, because your answer should absolutely shape the kinds of investments you pick.
Totally. If market swings keep you up at night, Your portfolio mix will look very different from someone who's okay riding out bigger ups and downs for potentially higher long-term gains.
And maybe the most fundamental mistake, highlighted everywhere, not having a long-term plan.
Just focusing on quick wins or reacting on impulse instead of investing with clear goals in mind.
Because investing, well, it isn't a get-rich-quick thing, is it?
Not usually, no. It's a tool. For hitting future goals, retirement way down the road, a house deposit in 5 or 10 years, maybe building passive income over time.
And without that long view, it's so easy to get sidetracked by the daily noise, trade too often.
Which racks up costs.
Yeah, fees and taxes. And you miss out on that real power of long-term compounding. Patience, consistency, they're key.
Okay, another one that kind of sneaks up on you. Investing without understanding the fees.
Oh, the hidden costs. Management fees, transaction costs.
Right. It's easy to brush off like, oh, it's only 1%, 1.5%. But the sources show how those fees compounded year after year.
They really erode your returns significantly.
Yeah, you think you made 7%, but if 1.5% went to fees, well, you didn't really make 7%. Understanding the fee structure, maybe opting for lower cost options is vital.
Definitely. And the sources also mention avoiding professional advice or tools, thinking you have to figure it all out yourself.
Right, going it completely alone. When actually using reputable resources, maybe a financial advisor for personalized help, or just good educational platforms can help you dodge a lot of these common expensive mistakes.
Makes sense.
And one more foundational point, some sources actually list this first, even before the others we mentioned.
Let me guess. The emergency fund.
You got it. Starting without an emergency fund.
Yeah, this one feels like a non-negotiable prerequisite before you even think about investing in the market.
You need that safety net. And the why is really compelling. Life happens.
Job loss, big medical bill, car breaks down.
Exactly. And if something like that hits and you don't have savings, you might be forced to sell your investments, maybe at a loss, maybe when the market's down.
Which just torpedoes your whole long-term plan.
Totally. So the advice is crystal clear. Get 3 to 6 months of essential living costs saved up. Put it somewhere safe and easy to access.
Like a high-interest savings account, maybe?
Yeah, something like that. That fund protects your investments from, life's curveballs.
Okay, phew. So that's the minefield, the common traps. It can sound a bit daunting.
It can.
But the good news, according to the sources, is that getting through it, building that solid foundation, it doesn't have to be super complicated. It really starts with asking yourself some basic questions.
Exactly. Before you even look at a specific stock or fund, you need to figure out your starting point. What are you trying to achieve? Your goals.
Retirement in 30 years, house deposit in 5.
Right. How much time do you actually have until you need this money? That's your time horizon. And then that risk tolerance question again, how comfortable are you with ups and downs?
And practically, how much can you realistically set aside to invest on a regular basis?
These answers aren't just like academic exercises. The sources show they're the bedrock. They guide your whole strategy, especially your asset allocation.
Which is just deciding how to split your money, right, between different types of investments.
Yeah, basically. What percentage goes into stocks, what percentage into bonds, maybe some in cash or other things. The sources highlight, for instance, someone young, saving for retirement decades away, probably okay with more risk.
They might put a bigger chunk into stocks, aiming for higher growth over that long period.
Exactly. Whereas someone needing the money sooner, say for that house deposit in 5 years.
You probably want more stability.
Right. So maybe more in bonds, which are generally less volatile than stocks, or maybe CDs. Things where preserving the money you have is more the priority than shooting for maximum growth in that short time frame. It's all about matching your investments to your personal situation.
Okay, got it. So once you have that clarity, what's next? The sources talked a lot about the power of the long term and discipline.
Huge emphasis on this. Focusing on the long haul helps you ignore those short-term market freakouts we talked about.
Staying the course, as they say, even when things get choppy.
And discipline just means making investing a regular thing, a habit, not just a one-time action. Consistency is absolutely key to harnessing compounding over time.
Which leads really nicely to a simple, powerful strategy for building that discipline almost automatically. Automating your investments.
Yes, setting up those automatic transfers.
Yeah.
From your bank account to your investment account, maybe every payday or once a month, whatever works for you.
It just happens. Takes the decision-making burden off you each time.
Exactly. No more temptation to try and guess the perfect moment to buy or deciding you'll just, do it later.
The money gets invested consistently, keeps you on plan, and dampens down those psychological traps.
And circling back to one of the mistakes, diversification. It's not just avoiding a mistake, it's a core principle for managing risk.
Right. Spreading the money out, different assets, different types of investments.
So if one part of your portfolio is having a bad year, hopefully other parts can balance it out. Leads to a much smoother investment experience, as one source nicely put it.
Makes sense.
Okay, so now, for folks who really want that straightforward, low-effort approach, the kind of set it and forget it style, the sources really focus in on two simple, effective methods.
All right, let's hear them.
The first one is dollar cost averaging, DCA.
Okay.
This strategy is pretty much designed to take the whole market timing anxiety off the table.
How does it work?
Super simple concept, actually. You invest a fixed dollar amount on a regular basis, say $100 every 2 weeks, and you do it regardless of what the investment's price is doing at that moment.
So you just stick to the plan, $100 goes in, whether the market's up or down that week.
Exactly. If the price is high, your $100 buys fewer shares or units. If the price is low, that same $100 buys more shares or units.
Okay, so over time.
Over time, by buying consistently through those ups and downs, the idea is you end up with a lower average cost per share than if you tried to guess the best time to invest one big lump sum.
Right. You see this in 401ks, right? Where money comes out of each paycheck automatically.
Perfect example. It happens automatically there. And there's a huge psychological win, too. It forces that consistency.
It takes the emotion out.
Right. It reduces the negative effects of investor psychology and market timing.
Right.
Because you're not making buy-sell decisions based on fear or greed day to day.
Okay. Any downsides?
Well, the sources point out it doesn't magically protect you if the market just keeps falling and falling. It's based on that long-term view that generally markets tend to go up over decades.
Got it.
And importantly, for someone who maybe isn't doing deep dives into individual companies, applying DCA to broad index funds is seen as much less risky than trying it with single stocks.
Okay. Which brings us nicely to the second big strategy for set it and forget it. Passive investing with index funds and ETFs.
Yes, and the idea here is, well, it's kind of brilliant in its simplicity. Instead of trying to beat the market by picking winning stocks or timing your moves, that's active investing.
Which we know is really hard.
Exactly, incredibly hard. Passive investing just aims to match the performance of a broad market index.
Like the S&P 500, tracking the biggest U.S. companies.
Yep, or a total U.S. stock market index, or maybe an international one.
And how do you actually do that?
Through index funds or ETFs. ETFs are exchange-traded funds. They're like index funds, but you can buy and sell them throughout the day like stocks.
Okay.
Both are basically just baskets. They hold all the investments that make up a specific index. So you buy one share of, say, an S&P 500 index fund or ETF.
And boom, you instantly own tiny pieces of all 500 companies.
Exactly. Instant, broad diversification with just a single purchase built right in.
And the key advantage everyone talks about, low costs, right?
Absolutely. That's the killer app, really.
Yeah.
These funds tend to have incredibly low expense ratios. That's the small annual fee the fund company charges. Much, much lower than most actively managed funds where you're paying a manager to try and pick winners.
And the data backs us up.
Hugely. One source we saw cited data.
Yeah.
Over a 10-year period, only something like 8.59% of actively managed large cap funds actually managed to beat the S&P 500 index.
Wow. Only 8.59%.
Yeah. After you account for their higher fees, most just didn't keep up with the simple index.
That's pretty compelling evidence for the passive approach.
It really is. It's the whole philosophy behind the Bogleheads community, named after Vanguard's founder, Jack Bogle. Their whole thing is diversify with low-cost index funds. Let compounding work its magic. Buy, hold, keep fees low, stay the course. Simple, but powerful.
And they often talk about just using a few funds, right? Like a 2 or 3 fund portfolio.
Exactly. Maybe a U.S. total stock market index, an international total stock market index, and maybe a total bond market index.
Right.
With just those 3, you can get really broad global diversification without making it complicated.
So index funds really let you build that balanced, diversified portfolio with just a few index funds, like the sources said. Cuts out all the work of researching hundreds of stocks.
For sure.
So, okay, for a beginner who wants that solid foundation, long-term growth without constant stress and tinkering, dollar cost averaging into low-cost, broad index funds or ETFs seems like a really strong strategy based on these sources.
It's definitely presented that way. Now, the sources do mention other approaches exist briefly, like growth investing focusing on fast growers.
Or value investing, finding stocks that seem cheap, like Warren Buffett.
Right, or income investing focusing on dividends. Even socially responsible investing aligning with your values. But they generally frame these as, maybe needing more work, more specific analysis.
Maybe not the first stop for a beginner aiming for simplicity and passive growth.
Potentially, yeah. The broad, low-cost index approach is often positioned as that ideal starting point.
Got it. Okay, so DCA index funds. Simple starting point. Now, even with set it and forget it, it's not literally zero effort forever, is it?
Not quite zero maintenance. You do need to peek under the hood occasionally. The advice is to regularly check your investments.
But not to panic about daily news.
No, definitely not for that. It's more to make sure things are still on track with your goals.
Because things can shift over time.
Exactly. Market movements can throw your original asset allocation out of whack. Maybe stocks had an amazing few years, and now they make up a much bigger percentage of your portfolio than you initially planned.
Which could mean you're taking on more risk than you're comfortable with.
Precisely. So periodically tweaking it back to your target percentages, that's called rebalancing, helps keep your risk level where you want it. It might mean selling a bit of what did really well and buying more of what lagged.
Okay. And even with passive index funds, just keep an eye out for, what? Big fee changes.
Yeah, maybe significant fee changes, though less common with index funds. But more importantly, check if your situation changes. Your goals, your timeline, your risk tolerance, life stuff happens.
Right. Your strategy might need to evolve as your life does.
It's about informed awareness, not obsessive checking or trading.
Okay, perfect. We've covered the traps, the core principles, some simple strategies. Let's just quickly crystallize the absolute key steps for someone listening based on this deep dive.
All right. First up, non-negotiable. Build that emergency fund. 3 to 6 months of expenses, safe and accessible, before you invest.
Then define your starting point. Know your goals, your time horizon, your risk comfort level, and how much you can invest regularly.
Prioritize low costs and diversification. Fees matter hugely over the long run. Spread your investments out. Key risk management.
Embrace the long term. Patience. Consistency. Don't let market noise shake you off course.
Consider automating your investments. Makes consistency easy. Builds discipline.
Explore those simple, effective strategies. Dollar cost averaging and using low-cost, broad market index funds or ETFs. Great way to capture market growth without being an expert.
And finally, review periodically, maybe once a year. Rebalance if needed. Make sure it all still aligns with your life and goals.
Yeah, following these steps, avoiding those common mistakes, it really can help you invest smarter, like the source has said, and build wealth steadily. Everyone's learning, right? But being informed and disciplined seems to be the core message.
Absolutely. Setting up that simple long-term system seems key, rather than getting lost in the weeds or the daily news cycle.
Okay, so as we wrap up this deep dive on getting started, here's that final thought to chew on, pulled straight from the data we talked about. Remember that stat?
But what about active funds?
Yeah. How only about 8.59% of active managers actually beat the simple S&P 500 index over a decade, according to one source.
Such a clarifying number.
So what does that tell you? Where should your energy and focus really go as you start out? Trying to outsmart everyone, pick the next big thing, constantly adjusting, or maybe focusing on just capturing the market's broad growth through low-cost diversification, consistent investing, and, well, patience. Something to definitely think about as you take those first steps.